So, hi, I'm Diana. I don't feel like I need an introduction, but I started Balance Tax 10 years ago. It's going to be 10 years old in August 2025, which is amazing. Marilyn was actually my very first hire back in, it would have
Oh,
been
probably not long after that.
2016.
Yeah.
I think you started like just casually.
Yep.
And then she joined the business full time in January last year. So, whoop, whoop. Yeah. So Marilyn has lots of experience in accounting and taxes specifically,
Yeah.
and yeah, and international business as well. So you're in good hands. All right. So money moves to make before June 30th. Marilyn, do you want to take that section away?
So when it comes to money moves, it's always making sure that you do it before the end of the financial year, which is June 30. So essentially what happens is that if you then start doing it after then, because maybe you haven't done your taxes yet, unfortunately they don't actually fall into the next financial year. So it's always looking at trying to get it all sorted now so that you can actually reap the benefit of what you're doing now, because if you leave it too late, unfortunately, it gets pushed out. So one of the things, especially, is if you have a high income year and you're going, how am I going to pay all the income tax on that? Have a look at all the expenses that you've got. Is there anything that you would normally pay in July that you can pay now? So things like that is you can prepay things like rent, subscriptions, insurance if you've got any training coming up for your team. If there's like this thing that you're wondering about, should I implement that on my website? Did you want to do it now rather than later? So basically what happens is by paying that now rather than later, you're actually putting the deduction, so the expense for it, into this financial year as well. And obviously it's the best thing to do if your income is strong this year. So the other thing is that outside of the business scope is for an individual, if you wanted to pop extra funds into your superannuation, especially as sole traders, we don't necessarily pay ourselves a wage per se. So we take money out of the business, but there's not usually amounts that then get shuffled off like they would if you, as if you're an employee, that would be paid to a superannuation fund. So by popping money in and doing it, it has to hit the super fund before the 30th of June. Then basically all you do is lodge a simple notice of intent to claim, and you can actually claim that as a tax deduction on your tax return. So it's an easy way to not only invest in your future, but save your dollars now as well. So yeah, next slide. So the other one is looking at your assets. So everybody knows what a profit and loss is. It is the backbone of most businesses, looking at your income and looking at your expenses. But there is actually another little one that sits off to the side called your balance sheet, which has your assets on it. So that's where things like your bank account balances sit, and any large equipment purchases that you use. So having a look at those and going, hey, when I take into account what's on my profit and loss, things like looking at if you can claim the deduction for those larger assets usually happens either quarterly or at the end of the year, because it's not something that you necessarily do every single time. So having a look to see if there's anything like that that can be expense that is actually going to make your profit and loss a little bit leaner, is always good to have a look at as well. The other thing is if you do use invoicing for your clients, seeing if there's any that have been sitting there for 6, 12, 18 months or more, and you're like, do you know what? I actually don't think I'm going to get this anymore. So having a look at those and essentially just writing them off. The best thing is don't actually remove them from any of your accounting systems. The best thing to do is create a credit note and apply it, because that means in 2 years' time, if that client comes back, you can actually look at your records and go, oh, well, this is what happened last time you came and grabbed something from me. Um, and it basically means that you can easily track what's going on if clients come back in 2 years' time and you don't necessarily remember their name, or they've changed it, or their name is slightly different. You've always got a track of what is going on. So doing the credit note is always a lot better than just removing it from your system altogether. And the other one is make sure that you have your records and logbooks in order. So this basically means making sure that if you are having a motor vehicle, you can actually do the logbook now and apply it for the for the financial year that's just gone because it should be exactly it should be the same rate. So you have to keep it for 12 weeks. So yes, it will be part in this year, part in next year, but at least you can actually use it and apply it to the year that's just gone. It also means that if you are a big traveler, unfortunately, if you don't have a logbook, your claim is capped at 5,000 kilometers with the new rate of 88 cents. So that's $4,400 maximum that you can claim. But with a logbook, say you spend, um, you've got your fuel, you've got your insurance, you've got your registration, you've got your cleaning, anything to do with your maintenance and repairs. All of that can be claimed with the logbook. So if you say spend $12,000 on all of that because you're a big traveler, that means you can actually claim your business percentage of that rather than just being capped at that 4,400. So the good thing with a logbook, it is valid for 5 years. So you only have to do it once every 5 years, thank goodness. But it also means that you can actually then do a calculation on which one is better for you and you claim the biggest deduction. So it's an easy win for 12 weeks of tracking everywhere you go. But yeah.
Yep. So that was one of the questions in the chat was how do I maximize my logbook deductions? So really great. So what you do is you track everywhere you drive for
Yep.
12 weeks in a row. A really big tip is to pick a busy 12 weeks for business
Yes.
because at the end of the 12 weeks, the logbook is going to tell you you traveled 50% personal, 50%, business, and then that's how you can claim 50% of your repairs, maintenance, running costs, petrol, all the things of the car. Okay? So that's a little bit of a hack. It matters when you keep your logbook, and you only need to get a new logbook if you have a new car. So if you change cars, then it's one logbook per car for 5 years.
Yep.
So yeah, it's a bit of work, but it's worth it if you drive a
Oh
lot.
no, very much so.
And I know there's some questions on super, but we have a whole section on super, so we'll answer all the super questions when we get to there. All right, so business check-in for end of financial year. So I feel like as entrepreneurs, we are all so busy in the day-to-day running our business that we don't always pause and take a step back and look at our business structure, our numbers. And so this is just a really good exercise to go through, just to make sure that you're all set up with the right tax registrations, the right business structure. So, what you want to do is have a look and see, have you hit the GST threshold? Maybe if you're not registered for GST, the GST threshold is when your business makes $75,000 in sales across 12 months of trading in a row. So, a big misconception is that it's 12 months in a financial year, but it's just 12 months of trade in a row is what the GST threshold is. So, if you are looking at your sales for the last 12 months and you're getting close to that, it's time to register. Now, the opposite is also true. Because we've seen a lot of businesses that have changed, right? And so the average business, I think, only runs maybe 3 to 4 years.
Yep.
So if you're a business owner who's been trading for longer than that, you've lasted longer than the average business, right? And also, anyone who's had a business for that long will know that there's different seasons of life, different seasons of business. And so, business is not like, oh, I start a business and then I grow and it just goes up and up and up. Like, business is more like, oh, great, I had a great month. Oh, I had a bad 6 months. Oh, another good year. Do you see? It's like this. So, sorry. So, sometimes things change. And so, if you are at the point where your sales have dropped and they're below 75,000 and you're not anticipating for them to be above 75, it might be something to deregister for GST if you don't need it anymore, right? So that's something to think about. Now, it's more than just, oh, you have to register or not. It's more of you have to think about your business and also your pricing because if you have been registered for GST, your customers are likely used to paying for GST. And if you're going to deregister, you don't have to do your quarterly BASes anymore, but then also you don't charge GST to your customer. So that's going to impact your pricing a little bit too. So just something to keep in mind. It kind of goes both ways just because we're in a season where some people are ramping up and other people are winding down. Uh, Next thing to check is,
Yeah.
I'm ahead of myself.
The only other thing to double check with the falling below the GST threshold is that if you do want to deregister, you actually have to do it yourself because it is not automatic. So you need to let the ATO know that, hey, I've fallen below what the threshold. I don't expect to be above that. So you basically just let them know that there's been a change in your business and you can deregister. But yeah, it's not automatic. So always keep an eye on it. It's always a good thing to look at. But yeah.
All right. And then now we're going to talk about super. All right. So maybe we'll run through the slides first and then we'll answer the questions.
Yeah.
Cool. All right. So take it away.
So you can make, as we mentioned at the beginning, you can make a personal super contributions, which can go up to your concessional super cap that you can claim to on your tax return. These have to be after tax deductions. So, sorry, after tax contributions. So if you have employment as well, it's basically what you get in your hand. It can't be a salary sacrifice or anything like that. But if you've just got your sole trader income, because you're basically taxed on all of that and it is all included as your income, that is included with those types of things as well. So you don't have to necessarily worry about the after tax if it's out of your sole trader and you're not listed as an employee. The only thing that we can say is that it takes time sometimes because a lot of things get paid by BPay. It can take anywhere up to 3 days for BPay to process it on your end and give it to the business that, like the super fund that it's going to. Extra if you pay it on a Friday and it has to go over the weekend. This is because of how BPay times their payouts to wherever they're paying it to, which is the thing that a lot of people don't realize that it does take a couple of days for BPay to settle. So what we say is that it needs to be in your super fund and reconciled by the 30th of June. So try to do it at least 10 days before that so that you've got that little bit of a buffer and you're not paying out money that you could have used and then not be able to claim the tax deduction for it. So the good thing with the notice of intent to claim is that as soon as they've got it in their bank accounts, they've applied it to your super fund membership. Basically, at any point, you can claim a notice of intent to claim. So if it is a case of, oh, I don't have the time to do that form now, as long as you have it done before your tax return is done, you're perfectly fine. So, and they can take anywhere between, I've seen some come back same day and I've seen some come back 2 weeks later. So it all depends on what's happening at the time. So, but as long as you've got it before you do your taxes, or even if we prompt you when you do your taxes and you just get it then before they're lodged.
So we have a question. So a financial advisor advised someone to put $2,500 per month into super,
Yep.
and they just wanted to confirm that the cap is 30,000 a year. So yeah.
Yep.
So what's the impact of that?
So the cap at the moment is $30,000 per year. Um, so it's just increased from last year as well, which is awesome. It seems to be going up and up and up, which is great. So basically that will mean that if it's done as an after-tax deduction, once you've got all of that done for the entire year, come July, you go, okay, let's do the notice of intent to claim and do it then. Because otherwise you're going to have to do 12 of them every time that you want to do it, which is going to be a nightmare. So if it's a case of you're doing it as the notice of intent to claim, you do it at the end of the year for that year, unless you're going to put, okay, I want to put 30 grand in January, and then you know that you're not going to do anything for the rest of the year. You can actually do that back in February, so it's already done and dusted. You should do them each year because I can see that that is the next question on there. So you have to do them for every financial year that they are relevant to. So say you need to catch up 4 years worth of tax returns, you have to do 4 notice of intent to claims because they will actually specify on them what financial year they are relevant
But
to.
they allow you to, the super funds won't always accept it though, if you wait too long. So
Yeah.
you want to make sure you do it
Yeah.
pretty promptly because it actually impacts the tax that the super fund pays.
Yeah.
So that's why the notice of intent to claim is required because if you're going to claim it as your tax deduction,
Yeah.
the super fund pays a different tax rate on that contribution than if you weren't going to claim it. So that's the whole point of the system and how it
I
works.
think the
But
longest
yeah.
I've seen has been 4 years, but the other thing is before you make those contributions to your super fund, give them a call and be like, hey, I want to do this. Give me the BPay details specifically for that because a lot of people don't realize that super funds in the back office tag them as different things. So that particular payment has to be tagged that it's a personal super contribution rather than just a generic contribution as well. So making sure that all of that matches up for them as well means that it's going to be easier when you do the notice of intent to claim later.
So, next super thing we want to talk about is the spousal contribution. So, this is uh, something that you could use if there's a case where there's two people in a household and one income level is significantly higher than the other. And so, if someone has taxable income of $40,000 per year or less, then the spouse that has higher income can contribute to the spouse's super that has lower income, and the one on higher income claims it as a tax deduction. And so, oh, sorry. No,
But only
sorry.
up to the
Yeah,
$540.
up to 540. Sorry.
Yep.
So yeah, so that's a situation where that would be used when there's a household that has incomes that are not, there's a big disparity between the incomes.
Yep.
And then we have the free
Oh,
money, government co-contributions, yes, which is a question that we've got as well. So
yep.
tell us about that.
So basically, if you are earning under $60,400, you can make a non-deductible super contribution, which basically means you are not going to be doing a notice of intent to claim for this money. So if you make a at least $1,000 non-deductible super contribution, which means no notice of intent to claim for that money, the government will give you up to $500.
So they match
Completely,
50%,
they will
right?
match
So if you put
50%.
in 800
Yep,
into your super, they will put in 400.
yep,
And they do this after your tax return is processed and it's automatically. So there's
yep,
nothing that you have to do. They
yep.
will just put it in there for you, like after your tax return has been lodged.
And there is a minimum amount of $20, which they will actually match the $20, 20 for 20, and it's only once you get to $40 that they'll actually start doing the 50%.
Oh, I
But
didn't know
yeah,
that.
if you want to put $20 in, they'll give you the whole $20. If you put
Yeah.
$30 in, they'll give you $20. You 40, 20, and then it goes up by then. But the minimum amount that they will pay in is $20. So
And so this is for all individual taxpayers. So that includes sole traders because when you're running a sole trader business, you're doing an individual tax return. It's just that you have a sole trader business to report inside of it. So yeah,
yeah,
so absolutely this is applicable to sole traders and people who are not sole traders. It's just not applicable to companies, trusts, partnerships, other structures.
yeah.
So yay. All right, 5 common tax mistakes that sole traders and individuals make because we want to avoid them. Yes, because
Yes,
nobody's got time to pay too much tax, right?
yes.
Oh, sorry. Do this last super
Okay.
question before we move on. So, I'm planning to make a larger contribution. Is it worth claiming as a deduction instead? Oh, then the co-contribution. You know what
Yeah.
I would do? Wait, so if your income is below the 60,000, then what I would do is I would put in 1,000 that you're not going to claim. So that way the government will match 500 and then you can put in,
Then you can put in a larger amount as well.
yeah.
So say you want to put in $31,000. Basically, you claim the put on a notice of intent to claim for the 30,000, and then the 1,000 you don't deduct, and they should match the 500.
Yeah.
So, yep.
Yeah. All right. So, top mistakes that sole traders and individuals make. So, claiming car expenses without a logbook. And this is where, the ATO, okay, so to be honest with you, a lot of sole traders will just use the cents per kilometer method because all you have to do is declare that you traveled at least 5,000 Ks for business and you
Yep.
get the 88 cents per kilometer rate. And so most people are pretty happy with their 4,000 some dollar tax deduction
Yep.
without doing any more work, right? But if you're one of those people who travels a lot for business, then it would be worth your time doing a logbook. But you've got to have a logbook because if the ATO ever asks to see it, you have to be able to show it. And I would say I've heard more recently of the ATO actually asking for logbooks.
Yep.
So I wouldn't skip that very important part.
Yep.
How long is the ATO able to go back and ask you for records?
7 years.
7 years?
So
Okay,
even
yeah.
though the logbook is valid for 5, they can go back 7. So always keep the last logbook that you've got as well. So keep your current and keep your last. So that if they come in 7 years' time and goes, hey, we want the logbook that you no longer use anymore, make sure you keep it. And a lot of people don't realize that because they think, oh, well, I can only amend for 2 years. This is only valid for 5 years, but they can go back to the statutory 7, which is kind of fun, but hopefully it's all
Okay,
good.
so with the logbook, can you create your own in a spreadsheet?
Yes, so there are certain things that you have to include. So you have to state the date of the travel, your opening odometer reading, where you went and why, if you've classed it for business or personal, and then your closing odometer. So you can there are ones where, say you go out to meet a client and you on the way home you quickly just pop into the shop, which is literally on your way home, or it's like a 1 kilometer detour, like something small. It's not like you live in Joondalup and you've gone to Coburn Sound because they've got like a really, really nice roast on special or something. But as long as it's actually on your way home, that's perfectly fine, as long as it's not too big a detour. But if it's a case of you did make a detour and it was out of the way, you would have to treat it as two separate trips. But
All
yeah,
right. So, next thing is a lot of people like to upgrade their cars sometimes, and they think, oh, I'm going to buy the most expensive car I can get
because it's pretty.
because I'm going to get a tax deduction for it. Well, the ATO has put a cap on a car purchase deduction because they consider, like, they think that you can get a good car for $68,000. And basically, if you pay above that, that's cool, but you can't claim more than 68,000. So for business.
Yeah.
So
It's because they class anything over 68,000, basically it's more of a personal purchase rather than a
yeah.
thing because of all the bells and whistles, the leather seats, the nice rims, the pretty paint job, and they just kind of go, yeah, nah, the subwoofer under the seat.
I think a lot of my tax trauma is from clients who have bought Porsches,
Yep, Lamborghinis.
Maseratis, whatever,
Yep.
and then they come to us after they buy it and go, "Look, I've got a big tax deduction. Yay!" And
I
I'm
know.
like, "Why didn't you ask me about this before?" No. Yeah, tax trauma, baby. All
Yep.
right. Next mistake is forgetting to lodge a notice of intent to claim, but we have talked about that heaps, so ain't nobody gonna do that here.
Nope.
And then not claiming a Medicare exemption when you're eligible.
Yep. So Medicare pretty much kicks in when you're sitting on around about $28,000 worth of income. You actually have to start paying the Medicare levy exemption, but that type of exemption is automatic. But there is actually one that isn't. So if you are here on specific types of visas, usually student visas, working holiday makers, you're actually not eligible for Medicare. So if you have to go to the hospital, unfortunately, you have to pay for it. You have to go to the doctor. You
Or you
don't.
have insurance. They have
Yeah,
insurance.
there is
Yeah. There's
insurance.
a special kind of insurance
Yeah.
that they have. Yeah.
So you have to pay for it or have the insurance cover it. So the thing is with the Medicare exemptions, if you don't have one because of your visa restrictions, you actually have to apply to have it exempted. Otherwise, the ATO will automatically apply it anyway. Even if you go, hey, I'm exempt, I don't need to have it without what they call a Medicare exemption certificate that you have to apply for from Centrelink or Services Australia, the ATO will just add it back on. You have
Yeah.
to have that exemption certificate. And because you can only amend your taxes back 2 years, even if you have been here for 5 years and you go, oh, hang on, no, I should have been doing those certificates. You can get certificates of 5 years, but you can only amend your tax returns for the last two.
Yeah. Just a
So,
lot of people who immigrate to Australia don't know this because when you
yep,
immigrate, there's no handbook given to you that says this is how to adult in Australia.
yep.
So,
And
yeah.
you can even say, I'm not a tax resident, and sometimes it will even calculate the Medicare levy on there for you anyway. But you have to have the certificate because basically the ATO, when you get their tax return, will go, hey, Services Australia, do these guys have an exemption? They haven't got a certificate. Cool, we're adding it back.
Cool.
But that Medicare exemption certificate can only be applied on the 1st of July for the prior year. So from the 1st of July forward, so the entire financial year has to have been completed first before you can apply.
Hmm.
Yeah.
I think while we're on the Medicare exemption, the Medicare topic,
Yep.
there's two in the tax return, there's two Medicares. There's Medicare levy
And
and then there's Medicare levy surcharge. What's the difference? Because a lot of people don't know.
so
So what's the difference?
So a Medicare levy is basically what most people have, except if they're exempted or they're in a low income bracket, and that basically goes towards the Medicare services that are provided for everybody.
So pretty much everybody,
Everybody.
almost everybody has to pay that, no
Yep.
matter what.
Yep.
Then the Medicare
Then
levy
the Medicare
surcharge.
levy surcharge. So depending on if you're a single, if you're a family and you've got kids, it changes. But basically around about $90,000 as an individual, pretty much double that if you're a family, and then sometimes a little bit extra for kids. Um, Basically, if you earn over that, you have to pay the surcharge if you do not have health insurance.
Well,
Now,
an adequate level of cover,
yeah,
right?
so
So
that's
it's not just basic hospital or
no. So what people get confused at is they will have health insurance and it's ancillaries only. So they can go to the physio, they can get their glasses, they can go to the naturopath, all covered. Perfect, no worries. But for actually not having to pay the Medicare levy surcharge, you have to have an adequate level of private hospital cover. It doesn't matter about anything to do with ancillaries, it's actually about the hospital because that is what has been deemed as where everybody gets a little bit stuck is the hospital cover.
yeah.
So when you're making sure that you don't have to pay that surcharge, make sure that it is hospital, not just ancillaries. And a lot of people get stuck on that. They're like, hey, but I've got private health insurance. But it's like, unfortunately, you don't have private hospital insurance, which is
Yeah.
unfortunately what it is.
So at some point, people need to weigh up, like if having private health isn't important to you,
Yep.
because for some people it's not, then you have to weigh up, do I want to pay the premiums for private health insurance just so I can get out of paying the Medicare levy surcharge, or do I just pay the Medicare levy surcharge?
Yep.
And I think the way that private health is priced, it's basically meant to be kind of even, but
If you
yeah.
only look at just the hospitals, not the ancillaries, it's even. When you add the ancillaries, it will be a little bit more. But if you're looking specifically at hospital, then it's
Yeah.
pretty much even.
Mm.
But yeah.
And the fifth most common mistake is forgetting to declare side gigs or crypto. So, I would dare say the ATO doesn't have a lot of information on people's crypto yet,
Yeah.
which bugs them. And so, a lot of their messaging is around, oh, don't forget to declare because it's all around the things that they don't know about. So, same as side gigs. So, one thing to keep in mind is if you have a side hustle, you actually don't have to put it in your tax return until it's considered to be a business for tax purposes.
Yep.
What is a business for tax purposes? Well, it's basically, does it walk, talk, act, smell like a business? Businesses have insurance. Businesses continually try to get new customers. Businesses are consistently open and trading. Businesses keep records. Business have dedicated business bank accounts, maybe a Square or a Thrive card, a Stripe, in order for people to pay them. So that's at that point when you're trading, that's when you need to report it in your tax return. But actually, if you just like have a side hustle and it's infrequent, you don't really try to get new customers, you don't necessarily advertise, you don't have a website,
You're doing it for your buddy at the
then
back.
you don't have to report the tax on that income, okay?
Yeah.
And then crypto, a lot of people forget that that has something to do with tax because that is income. So, yeah.
The buys and sells and all of that type of thing. And the thing is with crypto is also making sure that you keep very good records of it because sometimes they can get a little bit confusing. So
All right, now the next topic we just want to share is that, oh man, because 10 years of balanced tax, right? We have seen many different eras of the ATO, and the most recent era that we are currently living in is probably the one where the ATO, they just do not care. They don't care if you have someone close to you pass away and you forgot to do your tax return. They don't care if you're going through a slow time in business where you have health issues. Um, they don't care. All they care about is you lodging your tax return on time, keeping up to date with your BAS returns and super guarantees if you have that, and making sure you pay your debts on time. They are not flexible. And this is kind of a bit shocking, even for us as tax agents, because the ATO was so flexible a couple years ago. Oh, you need more time to pay? Sure, we'll set up a payment plan.
yep.
Now, when you request a payment plan from the ATO, they basically make you give all the information as if you're going for like a bank loan.
Yep.
Okay. And I've had situations recently where the ATO has literally told clients, sorry, you're not eligible for a payment plan. You got to go take out a loan and borrow the money to pay us, you know? And it's just like they do not care. So we just want to we're not the type of accountants that are like fear mongering or like unnecessarily scaring anyone. We just want to be frank and just let you know that the ATO is not flexible anymore because
Yep.
they did this 180 and they didn't really tell anyone. They just woke
Nope.
up one day about a year and a half ago and flipped the switch. And
Yep.
yeah, so that's the ATO we're dealing with now. So some other, okay, so now we're moving into what changes for next financial year, just so that way we can keep in mind things that are coming up.
Yep.
So yeah.
So kind of flowing on from that, we have a very different ATO than we used to. They, from the 1st of July 2025, any general interest charges that you may receive because you have been late with a payment are no longer deductible.
So the ATO charges 11% interest on payment plans, by the way,
Yep.
or late tax payments. And so this used to be a tax deduction because it's
Yep.
interest, but not anymore after July 1st.
No. They're
Um,
essentially pulling it into line with if you have a late lodgement fee, if you have a fine for non-payment, anything like that, which are all completely non-deductible. Now the interest will be as well. So it's all about trying to make sure that you put things in place to make sure that those debts are covered and you're not giving them money that you really don't want to and you're not getting any benefit out of.
So next change is that the super guarantee rate is going up. So anyone who has employment, you're about to get a half a percentage pay raise.
Yep.
You won't see it in your bank account, but you will see it in your super fund because employers are required, instead of paying 11.5% super guarantee, 12% for payroll payments made from July 1st onwards, 2025. So that's just something to keep in mind. If you have employees, then your super expense is about to go up a little bit.
Yep. And the one thing that some people forget with this as well is that say that your payroll period was the last 2 weeks of June, if your payment for that period is July, you get the 12%. So it's actually when the payment is made, not the period that it relates to. So just be wary that that last period in June, depending on when the payment falls, could actually be hit with the 12%, not the 11.5.
All right. And then we've got pay-as-you-go installments. Now, basically, the ATO is enrolling everyone who has an ABN, basically,
Yep.
in pay-as-you-go installments. They started doing this about 18 months ago, but only for those who had tax debts after they lodged their returns. But it's basically going to be across everyone who has an ABN. So what this means is the ATO every quarter is going to send you a little love message in your MyGov account saying, please pay us $2,000 of tax in advance for next year's tax return. Because up until this point, we have been able to save the money for our taxes in our own bank accounts, but the ATO wants taxpayers to give it to them in advance now, especially if you're running a business. What they're trying to do is get paid up front because they're the ATO, they're a revenue collection agency, that's their job. But then also, they don't want people, and it's often sole traders who
Yep.
end up with unexpected tax debts when they do their return, and then they're in this hole that they feel like they have to dig themselves out of.
Yep.
And let me tell you, because I've been there back in early days of business, it's the worst feeling to be working, earning money in your business to pay last year's tax debt. Like, and then on top of that, you have to save for the next year that you're in. Like, I think that there's probably a point in time in business where every business owner goes through that and then learns that lesson. And then they're just like, never again am I going to put myself in that situation. So yeah. If you haven't been enrolled in Pay As You Go, it might be coming. And once you're enrolled, it is not optional. You cannot opt out. I think that's our most common request from clients,
Yep.
actually.
When we opt out, it's like, oh, and I think one of the other
I
things,
don't want this. Opt me out.
yeah, unfortunately, the only way we can
Can't
opt
do
you
it.
out is if you cancel your ABN.
Yeah, but what you can do is vary the amount you want to pay to zero.
Yep.
At the moment, the ATO is not penalizing anyone for doing that, but eventually, the way things are going, they might start doing that.
Yep.
So that means that if you know you're going to owe 5,000 in your next year's tax and you choose not to give them any upfront, they might just come back and be like, "Oh, naughty you," slap on the wrist. Next year you need to actually pay us some money in advance.
Yep.
Like that's what it is now. And when they get more serious about it, we will tell you.
Yep.
But yeah.
The other thing to know is that sticking your head in the sand and pretending that they don't exist is not an option. Because the ATO, if you have not varied that installment down to zero on or before the lodgement due date, they will lock in that amount. So say they ask you to pay $2,000 and you go, do you know what? I didn't see it, therefore I don't need to do it. They will actually lodge that PAYGI for you.
Yeah, silence is
Mm.
acceptance.
If it's just PAYGI, say you don't have any employees, you don't have GST yet. If you have PAYGI, they will literally the day after it's due, they will essentially lodge it for you and lock in that $2,000. So if you want to reduce it, you need to do it before it's due. And even if you are on BAS, if even though say you a couple of days late with the BAS, you can still play with your BAS like with the GST figures because you're working them out. But that PAYGI cannot be changed. It actually comes up with an error saying, sorry, too late. This is what it is. So getting in early and going, do you know what? I've got a PAYGI installment that's due. Let's make that zero now. And then you don't have to worry about it. Then you can go, I didn't see it. It wasn't there. We'll just pretend it wasn't there. But yeah, making sure that you're actually on top of those and amending them and adjusting them as you need to before they're due is probably going to be your biggest tip because the ATO locks it in and you're done. So,
All right. So investing, if anyone has started investing in shares, crypto, ETFs, that type of
property.
thing, yeah,
Yep.
property, here are some investment tips that people don't really know of how you can save money on tax with investments. Okay. So basically, if you buy shares or a property, any type of investment, if you hold it for 12 months or longer, then when you sell it and you make a profit, you get 50% off the capital gains tax. So, what this is trying to do is encourage people to do long-term investing instead of
Yep.
being like day trading where you buy and sell like 1 month, next month. So yeah. So if you hold on to an investment for 12 months or longer, then you're eligible to cut your CGT in half.
But just so you know, just in case any of you also have a company out there as well, or your partner's got a company, or your best mate's got a company, this is only relevant for individuals.
Yeah.
So if you have a company that has investments, you can't do it. It's only for individuals.
Yeah.
And make sure that you get your timing right as well, because even if you buy it on the 1st of July and sell it on the 30th of June, you've lost it. It has to be 1st of July to 1st of July.
All right. Choosing the right, I don't know what this, you wrote this one. What is this?
So in my previous life, I worked with a lot of brokers and worked with corporate financiers. So one of the things that I realized working in this pool of brokers is that there were some I was happy to give my money to, and there were others that I'm like, maybe not. So, and that was literally all in one room. So it's always a case of making sure that you are finding a broker that is right for you, that fits your vibe with investing. Because you can have people that are very, they want to take that risk. They want to know if they can gain that 100% increase or profit on that one. Or they're like, you know what, I'm just happy doing the 10% because if you go for the big deal, sometimes you lose, sometimes you win, sometimes you lose. So finding a broker that kind of fits with your vibe, fits with what you want to do, understands what you're trying to achieve with investing is probably one of the biggest tips you can have. Because the last thing you want to do is have a broker constantly sending you emails about things that you're not really interested in, or they can be too pushy, or they're not pushy enough. So making sure that you are finding one that it fits you and also one that is educated enough to actually give you all the information that you need to be able to make that decision on whether you want to buy or sell, because the ultimate decision is yours, not theirs.
Yeah.
So,
So some people when they invest, they go with brokers. And
yep,
then also you can do it, they have do it yourself things like now, like the Concept Pocketbook app. Vanguard has like an app where you can register and buy and sell your own shares. So what they'll do often for the apps that kind of it's like they're acting as a broker, but they're not a
yep,
broker. They're just an app. And so
yep,
what they'll do is they'll have like a couple of choices of different funds and you can just pick one and invest in it as you want.
yep.
So there's a couple different ways to get started investing, but yeah.
So
So
it's either find a broker or be your own broker.
and any fees that you pay in terms of brokerage fees or app fees in buying investments, that actually gets your capital gains tax down, so you'll be able to claim those when you sell.
They're all deductible.
Okay, so offsetting capital gains with capital losses.
So, say you have a large capital gain that you know is coming because something's happened. You've sold an investment and there is a large capital gain, and you're sitting there just going, awesome. So, how do I pay the tax on that? So one of the things that you can do is if you have anything that is what they call underperforming, so you know that it's going to be a loss, you can actually use that loss, basically just get rid of it, sell whatever investment it is, and basically put it against that gain to reduce it overall. So it basically means that you are legally not paying as much tax on the capital gain because you're using this capital loss to apply against it to reduce it.
So the way you get a capital loss is you buy an investment and you sell it for less than what you bought it for. So you made
Yep.
a loss. If you have a loss in your tax return and you don't have any gains in that year, then you get to carry it forward to
Yep.
future years and it will just sit there until you have a capital gain at some point, and then you can offset your future capital gains against those carry forward losses.
Yep.
But yeah.
So sometimes if you unless you specifically need the money, sometimes selling the tax loss at the same time as the time you're going to have a gain, you can actually hold on to them either in your tax return or for when you're actually going to have those capital gains. Yeah.
Cool. And to wrap up, before we do a Q&A, then we just want to talk about, because sometimes sole traders get to a point where they're growing, and some people want to know, when am I meant to be a company? And so we're not the accountants who are going to push you to be a company before you're ready to be, but we just want to give you a heads up as to some things that might be some indicators of when most people consider switching to a company. So basically, if you are trading 130,000 in profit per year, then the reason why you might want to switch to a company is because companies have a flat tax rate of 25%, where sole traders, if you make 130K, you're paying 25% tax. But sole traders, if you make 150 or 200 in your business, then your tax rate goes up all the way up to 45% is the top tax rate. So that's one reason why people want to switch to a company, because they want to earn as much money as possible and just pay a flat 25% tax.
Yep.
If you've got employees, there is like another level of business risk that you're subject to. And a lot of people, when they're sole traders, you have to realize your ABN is in your own personal name. So there's no legal separation between you and your business. So all of your personal assets, your home, your cars, your money in the bank, it's all kind of at risk because it's exposed to the business risk. So this is all about protecting risk, this part of it. But when you have employees, you got to make sure that you're abiding by all of the fair work rules, all of the employment laws in Australia, and so that's a level of risk that a lot of people are like, you know what? I want to be a company because I want to protect my personal assets from the business.
Yep.
Same thing with a commercial premises because you might have, different people walking into your office or into your storefront and you don't know if they hurt themselves, what might happen of that. So there's just another level of risk. Most businesses, when they get to the point that they're going to get a commercial lease for like a storefront, then I would never recommend anyone sign a commercial lease in your own name. Okay. You need to sign it in a company name. And when you go and do that, the agent or the landlord will probably ask you to sign a personal guarantee. If there's any way you can negotiate out of that, I would do it because what the personal guarantee is doing is saying, oh, we know you have a company and the company is leasing this building, but if something goes wrong with your company, then we're going to come after you. And that's what the personal guarantee is. So you can choose whether or not you want to sign it. They will ask you to sign it, and it's up to you to be like, actually, I don't want to do this. Can I pay a higher bond, like a higher deposit amount, or is there something else we can do so that way I don't have to do that? If you're losing sleep at night because the business risk is like, oh, I'm afraid that something's going to happen, and you want to just protect yourself a little more, then setting up a company is the next step for you. And if your business is growing fast, so we've probably helped, I would say about 10 clients in the last 3 months
Yep.
because people are looking at their numbers, doing their end of year check-in. What are my sales and what is my profit looking like? And noticing, oh, wow, like my business has really
Yep.
grown. Like I know I've been busy doing all the things, but look, I grow boss so hard,
Yep.
trying to be a company. And so we've helped them go through that process of being a company and transitioning and making it really easy for them. So just something to keep in mind.
So yay, getting
All
all
right.
the tax things done. So it's
Well,
good.
thank you for taking the time to join us, ladies. And any questions, just pop us through an email. Happy to answer and help. And yeah, uh, there we go. Thank you.
Yay.
Bye. Enjoy the rest of your
Have
day.
a wonderful day. Bye.